It's 4:58 p.m. on a Tuesday. Somewhere in a glass tower in Manhattan, a trader glances at a screen. In 2 minutes, a piece of the global financial system is about to run out of cash. Not a bank, not a country, the system itself. He doesn't panic. He's seen this before. He picks up the phone and borrows $9 billion. For one night. From a stranger he's never met. By tomorrow morning, the money will be gone again, paid back with a few dollars of interest, like it was never there. This happens every single night. Trillions of dollars, changing hands, for less than 24 hours, in a market almost nobody outside of Wall Street has ever heard of. It's called the repo market, and if it ever seizes up for real, it won't just be Wall Street that feels it. It'll be you at the ATM, wondering why your bank suddenly looks nervous. Here's the uncomfortable part. This market isn't a sideshow. It's the plumbing. Every bank, every hedge fund, every pension fund needs cash on hand every single day to settle trades, cover withdrawals, and meet rules regulators put in place after the last time this all went wrong. But holding piles of idle cash is expensive. Money sitting still doesn't earn anything. So instead, banks keep just enough cash to get through the day and borrow the rest overnight from someone who has a temporary surplus. Tomorrow, they give it back. It's not a loan in the way you'd think of a loan. It's a rental. You don't borrow the money for free, and you don't borrow it on trust either. You put something down, usually U.S. Treasury bonds, the safest asset on earth, in theory. You hand over the bonds, you get the cash, and tomorrow you swap back. Cash for bonds, bonds for cash, plus a small fee for the privilege. That fee has a name, the repo rate. It sounds boring. It is until it isn't. Let's slow this down, because the mechanics matter. Say a hedge fund owns $100 million in treasury bonds. Safe, but not spendable. A money market fund, on the other hand, is sitting on $100 million in cash it needs to park somewhere safe overnight, earning a little interest. So they make a deal. The hedge fund hands over the bonds as collateral. The money fund hands over the cash. Tomorrow morning, they reverse it. Cash goes back, bonds go back, and the money fund pockets a small return for the one-night favor. Multiply this handshake by thousands of institutions every night, and you get a market that moves somewhere north of $4 trillion a day. Not a year, a day. It's the largest, fastest-moving market most people will never hear a single headline about. And here's the part that should make you a little uneasy. Almost the entire modern financial system quietly assumes this market will always work. Banks build their balance sheets around it. The Federal Reserve steers interest rates through it. Hedge funds use it to borrow money they don't have, to buy more bonds than they could otherwise afford. A strategy so common, it has its own name, the basis trade, and it depends entirely on repo funding being cheap, available, and boring. The whole system is built on an assumption that a stranger will always answer the phone at 4:58 p.m., which brings us to September 2019. For years, this overnight rate barely moved. It sat quietly around 2%, doing its job, attracting zero attention. Then, over 2 days in September, it spiked. Not a little. It touched 10%. Some desks reported trades even higher. To be clear, this is a rate that's supposed to move in fractions of a percent. It doubled, then tripled, in about 48 hours. Why? A pile of unrelated events landed on the same day. Corporate tax payments pulled cash out of the system. A large treasury bond settlement pulled out more. And banks, sitting on piles of regulatory mandated reserves, simply weren't willing to lend that cash out, even for one night, even at a profit. Cash was there. It just wasn't moving. And when cash stops moving in the repo market, borrowing costs everywhere else start climbing with it, because this market is the reference point half the financial system quietly prices itself against. The Federal Reserve had to step in, pumping tens of billions of dollars into the market within hours just to bring the rate back down to earth. It kept doing this, night after night, for weeks. Nobody outside finance noticed. There was no stock market crash, no headline on the evening news, just a quiet, expensive scramble, 3 floors below the world most people actually see. That's the part that should stay with you. The scariest failures in finance rarely look like failures while they're happening. They look like a slightly unusual number on a screen that only a few hundred people in the world are watching. Now here's where hype and reality split. The hype says, don't worry, the Fed will always show up. It did in 2019. It did again in 2020, when the pandemic triggered a similar scramble, this time even faster and even larger. Every time, the Fed opened the tap, cash flowed, and the number went back to normal. The reality is less comforting. Each rescue treats the symptom, not the cause. The system still requires a healthy overnight market to function every single day, and every fix so far has been reactive. The Fed noticing the fire after it starts, not before. There is still no guarantee that the next disruption arrives on a quiet Tuesday with time to spare. It could arrive during a banking crisis, a geopolitical shock, or a moment when the Fed itself is distracted trying to fight inflation instead of a funding freeze. And there's a quieter irony sitting underneath all of this. The very regulations written after 2008 to make banks safer, forcing them to hold more reserves, more high-quality collateral, are part of what made banks reluctant to lend that same cash out overnight in 2019. The safety rules, in a strange way, helped starve the market of the liquidity it needed to stay calm. Make the system safer in one place, and you can just as easily make it more fragile somewhere nobody's watching. Zoom out, and the stakes get bigger than a strange afternoon in September. Trillions of dollars in daily transactions depend on the assumption that overnight cash will always be available, always be cheap, and always be boring. Hedge funds have leveraged this assumption into trades worth hundreds of billions of dollars. Banks have built it into how they manage risk. Governments finance themselves partly through it, because treasury bonds are the very collateral that makes this whole market run. If confidence in that assumption ever cracks, really cracks, not just a 2-day spike, the ripple isn't contained to a trading floor. It's mortgage rates. It's corporate borrowing costs. It's whether your bank can meet withdrawals on a normal Monday. The system was designed by very smart people to be efficient. It was not obviously designed to be unbreakable. Those are different goals, and most of the time, nobody has to choose between them. Most of the time. So here's the question worth sitting with. Every night, trillions of dollars move through a market most people will never see, resting on a simple promise that tomorrow, someone will still be willing to answer the phone. For decades, they have been. The question isn't whether this market has worked so far. It clearly has. The question is what happens the day it doesn't, and whether anyone will notice before it's too late to matter.